Good afternoon, and welcome to the Deep Dive. Thanks for joining us today as we try to make sense of, well, a pretty wild day in the markets. We're digging into the sources around October 13th, 2025.
Yeah, thanks for having me. It was definitely one for the books.
It really was. I mean, you saw this incredibly aggressive rebound. It almost felt violent, the way it clawed back those huge losses from Friday. The headlines looked great,
Yeah.
U.S. equities up strongly across the board.
Oh, absolutely glowing. A dramatic turnaround from the pessimism that had really built up over the weekend. You had the NASDAQ composite leading the charge, surging, what was it,
It's
2.26%?
over 500 points, yeah.
Yeah.
Closed above 22,700.
Incredible. And the S&P 500 wasn't far behind, up 1.66%. So looking just at that, you'd think, okay, risk is definitely back on. The market's feeling confident.
But that's where it gets weird, right? And that's really the core question for our deep dive today. If risk is really back on, why did we see safe haven assets, gold, silver, hitting new all-time highs at the exact same time?
Exactly. That's the central paradox. The sources are calling it a bifurcated market, and that feels about right. It just doesn't square up.
So you have this massive equity rally, but then gold.
Gold futures jumped 2.4%, settling at a brand new record high. We're talking over $4,000 an ounce now. And silver wasn't messing around either. It surged over 5%, also hitting a record.
Wow. And the VIX, the fear gauge.
Still stubbornly high. It held well above that key 20 level, significantly higher than where it was before this whole trade flare-up started last week.
So it's not just a little disagreement in the market. This is like the market yelling two completely different things at once. Risk assets cheer, but the cost of protection, the hedges, they're still sky high.
Precisely. It's a flashing sign of really profound underlying uncertainty. The market is essentially cheering a very short-term piece of news, a geopolitical headline shift, which we need to unpack. But underneath that surface optimism, it's still wrestling with these huge structural risks.
Yeah.
You got the obvious one, the geopolitical fragility, but also critically, this domestic policy paralysis because of the ongoing government shutdown. That shutdown is creating a real data vacuum.
Okay, so that's our mission today. We need to unpack why the market sent these completely contradictory signals. What actually drove this huge rebound? Where did the money really flow? And maybe most importantly, what does all this volatility mean for you, the listener, trying to invest when you're basically starved of reliable economic data?
Yeah, a tough environment to navigate.
So let's start with the immediate spark. What kicked off this reversal?
Well, it wasn't fundamentals, that's for sure. The initial move was purely sentiment-driven, just classic geopolitical whiplash, all centered around U.S.-China trade talk.
Okay, so to really get Monday's rally, we need to remember how bad Friday felt. That was genuine fear, wasn't it?
Oh, absolutely. The S&P and the NASDAQ had their worst day since April, a massive sell-off. And it was triggered directly by President Trump, threatening those potentially crippling 100% tariffs on Chinese imports.
Which was his reaction to China curbing rare earth exports.
Yeah.
Sort of tit-for-tat escalation.
Exactly. And that threat, the 100% tariff idea, that really spooked the market. It set the stage for a weekend where everyone was bracing for a full-blown trade war escalation. The kind of scenario that historically just crushes markets and freezes business investment.
Right, expecting the worst on Monday morning. But instead, we had the opposite.
We got this abrupt pivot. It started happening even before the market opened, driven entirely by President Trump's comments over the weekend, much more conciliatory.
He basically walked it back, saying things like, don't worry about China, it will be fine.
Pretty much, yeah. That plus reports that there was, substantial communication happening between the two sides. Just a hint of dialogue, the de-escalation in rhetoric, was enough to prompt an immediate repricing of risk.
You saw it in the futures market right away.
Instantly. Dow futures were up, nearly 1%. But the NASDAQ futures, which are always the most sensitive to this stuff, they jumped about 1.68% before the opening bell even rang.
So that rapid verbal U-turn seemed to confirm what a lot of traders were maybe hoping for or even betting on?
It fed right into this theory, yeah.
Yeah.
The idea that the aggressive threats were really just a negotiating tactic.
Which brings us to this very cynical market theory that popped up everywhere on Monday. The taco trade.
Ah, yes, the taco trade. Stands for Trump always chickens out.
Crude but descriptive.
It is. It's basically a trading pattern built on observing this behavior. You get really aggressive, market-shaking rhetoric used almost like a tool to gain leverage in negotiations. But then, the theory goes, once the market reaction gets too scary or the potential economic damage looks too severe.
The administration softens its stance, pulls back from the brink to avoid, crashing the economy, which wouldn't be good for anyone, especially domestically.
Exactly, to avoid that severe economic fallout that could hurt growth and ultimately consumer sentiment back home.
But here's what I don't get. If this pattern is so predictable, if traders sort of expect the eventual pullback, why does the market still react so violently to the initial threat? Why did we have the biggest sell-off since April on Friday if everyone secretly thought it was just posturing? Isn't the market just hurting itself by overreacting to, well, theatrics?
That's the beautiful, frustrating paradox of it. The market has to take the initial threat seriously. Because what if, just what if, this time it isn't a bluff?
Right. The consequences are too big to ignore.
Exactly. If those 100% tariffs actually happened, the economic damage would be catastrophic. You simply can't afford to wait and see if it's real this time. So the rational move is to sell hard on Friday, hedge that potential catastrophe.
And then buy back just as hard on Monday when the threat seems to recede.
Precisely. When it looks like it was, in fact, just a temporary negotiating stance again. The market ends up rewarding the traders who play that pattern, who bet on the reversal. It prioritizes that short-term momentum swing over its kind of, deep, long-term strategic thinking.
So this dynamic keeps happening where political talk, not earnings or data, becomes the main driver.
It completely overshadows traditional analysis, especially in this kind of environment.
And the numbers from Monday's close really show the scale of that behavioral whiplash. The recovery was just enormous.
Staggering. It was broad-based, too. The Nasdaq, being the tech and trade bellwether, led the way, surging 501 points, up 2.26%.
And the S&P 500 gained back almost 60% of Friday's big loss in just one session, up 1.66%.
Just incredible. And look at the global picture. It tells you so much about the speed of this sentiment shift.
Yeah, that divergence was really telling.
Asian markets, like the Hang Seng in Hong Kong, they traded before Trump's conciliatory comments were fully absorbed. And they actually fell, down about 1.5%.
But then Europe, trading later.
Right. European markets opened later. They had time to price in the de-escalation, and they posted modest gains. The DAX, the FTSE 100, they were up. That time lag just highlights how hyper-reactive global markets are right now. They're hanging on every single geopolitical headline in real time.
It feels like the market is just starved for real information, for fundamental data, so any little scrap of news, especially political news, fills that void instantly.
That's a great way to put it. And that creates this intense volatility. So to really understand what investors are actually thinking, you can't just look at the index level. You have to dive deeper, look at where the money actually flowed. Sector leadership tells a crucial story.
Okay, let's do that deep dive into the sectors. Unsurprisingly, I guess, the sectors that got hammered the hardest by the trade fears led the recovery, right? Tech, semiconductors.
Absolutely. They had the most to lose from a tariff war, so logically they had the most to gain from the relief rally. The momentum was obvious even before the market opened.
We saw some big pre-market movers.
Huge moves. Micron, MU, which is super sensitive to global memory chip demand, was up 4.8% pre-market. Taiwan Semiconductor, TSM, the giant global foundry, also up 4.8%. AMD popped 3.6%. Just broad strength signaling that bullish sentiment was flooding back into that space.
Even NVIDIA, the big AI leader, it gained too.
Yep. NVIDIA still added a solid 2.5% during the main session. Strong day all around for the chip space.
But within that tech rebound, there was one company, one specific catalyst that maybe signals something bigger, a longer-term shift in how AI infrastructure gets built. I'm talking about Broadcom.
Ah, yes, Broadcom, AVGO. They soared, what, 6.8%? That was on the news. They struck a multi-year deal with OpenAI.
To develop custom chips, right?
ASICs.
Exactly. Application-specific integrated circuits. And the implication here, I think, goes way beyond just Broadcom's stock price. The first wave of this AI boom, it was all NVIDIA. Their general-purpose GPUs were, and still are, fantastic, flexible tools.
But for the really huge players like OpenAI, who are training and running these absolutely massive proprietary models, the large language models, the LLMs, the economics of using only general-purpose hardware start to get challenging.
Challenging how? What's the pain point? Is it just cost?
Cost is a huge part of it, yeah. But it's also efficiency at massive scale. Think of it running tens of thousands of GPUs nonstop. The power consumption is just astronomical. And latency, the time it takes for the chip to do the specific calculations your unique model needs, it might not be optimal with the general chip.
So a custom ASIC is tailored just for OpenAI's models.
Precisely. engineered for one job and one job only,
Hmm.
running OpenAI's specific workloads. The potential benefits are huge. Lower operating costs because they're way more power efficient, and significantly reduced latency, which makes the whole model run faster and cheaper. For these hyperscalers, it's becoming less about just buying off the shelf and more about optimizing for their specific massive needs. It's almost an economic necessity at that scale.
Okay, so for the listener, maybe someone holding NVIDIA stock, how worried should they be? Is this custom chip trend an existential threat, or is it more niche?
That's the key question. Look, it definitely creates a new investment narrative, and it is a potential long-term challenge to NVIDIA's total dominance at the very highest end. But is it an immediate existential threat? Probably not.
Why not?
Because NVIDIA still absolutely dominates the market for, smaller and medium-sized AI players, for research, for tons of generalized computing tasks. But this Broadcom OpenAI deal, following similar moves by Google, Amazon, Microsoft, it confirms that the biggest tech giants, the ones spending the most on AI infrastructure, are increasingly going custom.
So it fragments the very top end of the market.
Right. It means the total addressable market for those truly cutting-edge, proprietary AI compute systems isn't all going to go to generalized GPUs anymore. It puts a potential ceiling, maybe, on NVIDIA's growth purely within that hyperscale data center segment over, say, the next 5 years. So as an investor, you now need to pay attention to this broader ecosystem, the custom silicon designers like Broadcom, not just the GPU kings.
Definitely a structural shift to keep an eye on. Now, while money poured back into tech, we also saw this just explosive rally in another area, the material sector. And that seemed like a direct reaction to the geopolitical worries.
Oh, completely. The surge in materials was all about that rare earth elements story.
Yeah.
China threatening those export curbs last week was a real wake-up call. It just starkly highlighted how vulnerable U.S. supply chains are for these critical materials. They're essential for everything from fighter jets to iPhones.
And the market basically said, okay, if supply from China is risky, then domestic or non-Chinese sources are suddenly worth a lot more.
Exactly. A massive repricing happened almost overnight. The market realized that supply chain security itself now commands a huge premium. It's not just about the cost of the commodity anymore. It's about the reliability of the source.
And the moves in those specific stocks were just wild. It shows how seriously the market took that geopolitical risk.
Unbelievable moves. MP Materials, MP, which is a key U.S.-based producer, shot up over 25%. Critical Metals, CRML, another company focused on these strategic materials, jumped nearly 50%.
50% in a day. Wow.
Yeah. And even a smaller player, United States Antimony Corp, UAMY, was up over 36%. These aren't small adjustments. It's a fundamental revaluation. It tells you the market now sees these commodities as geopolitical assets, as national security priorities, not just industrial inputs. Traders are betting that regardless of today's trade truce talk, the long-term game is about decoupling supply chains and boosting domestic production of critical minerals.
Okay, so beyond those big geopolitical themes in tech and materials, the overall positive mood seemed to be helped by some specific company stories too, right? Individual catalysts that added to the confidence.
Definitely. You had several things feeding the positive sentiment. Take Warner Bros. Discovery, WBD. Their stock rallied over 4%. Why? Because news came out that their board officially rejected that takeover offer from Paramount Skydance.
And the market like that, usually M&A rejection isn't seen as positive.
Right, but in this case, the interpretation was different. It wasn't seen as a failure to get a deal done. Instead, the market read it as a strong vote of confidence from WBD's own management and their company's standalone value. Like they were saying, this bid undervalues us, we're worth more on our own. That boosted investor confidence in WBD's outlook.
Interesting take. And we also saw that theme of AI's massive energy needs creating some big winners.
Absolutely. This is becoming a huge investment theme. Who powers the AI revolution? Bloom Energy stock just skyrocketed, up nearly 30%.
30%, what was the news there?
They announced a major deal with Brookfield Asset Management. Bloom's fuel cells are going to be used to power AI data centers. This is huge validation for their tech as a potential solution decentralized, maybe cleaner to the enormous power demands of AI infrastructure, which are starting to strain grids. It basically rewrites Bloom's story from just clean energy to essential AI enabler.
That's a powerful narrative shift. And even just plain old analyst upgrades played a role in setting a positive tone.
They did. Some of the classics still work. Estee Lauder, EL, climbed 3.5% after Goldman Sachs upgraded them to buy. The analyst note talked about reaching a fundamental inflection point, expecting sales growth to come back. That kind of call helps confirm maybe the worst is over for certain consumer names.
Any other little signals?
Well, you had Apple, AAPL, up 1.5%, partly on whispers they might acquire an AI startup called Prompt AI. Again, feeding that everyone needs more AI theme. Even Disney, DIS, got a 2% bump, reportedly on news about a Taylor Swift docuseries. Sometimes just about content buzz.
So it really felt like a confluence of positive factors. But fundamentals do still matter, right? There was at least one company that got punished.
Yes, and it's important to remember that. Fastenal, Fast, was the big loser for the day, dropping over 7%. They reported pre-market earnings, and the numbers were disappointing.
And Fastenal is kind of an industrial bellwether.
Exactly. So it's a crucial reminder. Even when the overall mood is euphoric, even when the macro narrative seems positive, if a company delivers poor results or weak guidance, especially an industrial indicator like Fastenal, the market will still punish it aggressively. Underneath all the geopolitical noise and sentiment swings, earnings quality and execution eventually matter.
Okay, so we've got this picture. Geopolitical relief driving the bus, supported by some specific tech trends like ASICs, the rare earth security premium, and individual corporate wins. It all paints a picture of a strong up day. But now we have to circle back to that fundamental contradiction, the elephant in the room. All this equity excitement happened while defensive assets were hitting records.
We just can't emphasize this enough. This fracture in the market's conviction is deep. That surge into safe havens wasn't just a blip, it felt structural. Gold futures hitting a new all-time high above $4,000. That was its 9th consecutive week of gains.
9 weeks straight for gold. That's not a reaction to one day's news, that's a trend. What's driving that sustained structural bid for gold even when stocks are rallying?
It's several deep currents converging, I think. First, as we discussed, geopolitical risk isn't seen as a temporary problem anymore. It's viewed as a constant underlying condition. Gold is the classic hedge against that kind of global instability.
Makes sense. What else?
Second, there's real concern about potential policy errors. Central banks, especially the Fed right now, are operating without their usual clear inflation data because of the shutdown. That increases the risk they might make a mistake and cut rates too soon, or maybe not soon enough. Gold has always been a hedge against both inflation and monetary policy uncertainty.
So, uncertainty about the Fed's next move, fueled by the data blackout.
Exactly. And third, there's ongoing, well-documented buying of gold by central banks around the world. They're diversifying reserves, maybe hedging against long-term erosion of the U.S. dollar status. That provides a steady, persistent demand floor that isn't necessarily tied to daily stock market moves.
Okay, that explains the gold strength. Now, what about the VIX staying elevated, above 20? What does that signal from the perspective of, say, a big institutional investor?
The VIX basically measures the expected volatility over the next month. Think of it as the price of portfolio insurance, like put options. When it's holding above 20, that insurance is historically expensive.
So people are paying up for protection.
They are paying a hefty premium. And that high cost is proof of deep institutional skepticism. It's like they're saying, okay, we'll play this short-term equity rally, maybe driven by the taco trade hopes, but we don't really trust it. So while they might be buying S&P futures with one hand, they're using the other hand to buy expensive downside protection, the gold, the silver, paying up for those VIX-related options because they fundamentally doubt the stability of the current market and the durability of this trade détente.
It really does sound like two completely different mindsets operating in the same market at the same time.
You've hit it. It reveals this deep fracture, these two distinct investor camps. Camp one, you've got the short-term momentum traders. They're chasing the rally, betting aggressively on the taco pattern, repeating, playing the buy the dip game. Their focus is the immediate return, the next headline.
And Camp 2.
Camp 2 is, let's say they're more strategic long-term money. Institutional asset allocators, pension funds, maybe longer-term hedge funds. They see this geopolitical truce as incredibly fragile, built on words, not concrete policy changes. For them, this brief equity pop, this pocket of optimism, is actually a strategic opportunity.
An opportunity to do what?
To increase their defenses. They're using the rally to take some profits from the equity surge and rotate that capital into gold, silver, maybe those pricey VIX hedges. They're preparing for the other shoe to drop, hedging against those deeper risks, the government policy errors, the chance trade hostilities flare right back up.
So we have a rally built on fragile hope, being actively counter-hedged by players focused on structural reality. That doesn't sound like a very stable foundation for the stock market rally.
It's exceptionally fragile because it's driven purely by sentiment, by hope, and it completely lacks reinforcement from clear, positive economic data right now. It's basically a momentum trade running on the fumes of relief. And that makes the whole market structure incredibly vulnerable to a sharp, sudden reversal, just like we saw happen in reverse on Friday.
So any negative headline could potentially puncture this optimism very quickly.
Easily. The market isn't fundamentally safe right now. It's just reacting momentarily to the least bad news available.
Which brings us perfectly to the next crucial piece. How do you even navigate this market when there's this information vacuum? The government shutdown is really changing the game for investors this week.
It really is. The shutdown creates this dangerous blind spot, not just for us investors, but critically for policymakers too, especially the Fed. The closure means key economic data releases are simply postponed.
Which reports are we missing?
The big ones. We won't get the Consumer Price Index, CPI, our main inflation gauge. We won't get the Producer Price Index, PPI, which tells us about costs further up the supply chain. And we won't get the monthly retail sales figures, which are vital for understanding consumer health. Without that core data, the market and the Fed are essentially flying blind.
Wow. Okay, without CPI and retail sales, the two reports we usually rely on most heavily for inflation and consumer strength, what can investors look at? What data becomes more important?
We're forced to lean much more heavily on secondary data points. They suddenly take on outsized importance. Probably the most critical piece of official U.S. data we will get this week is the Industrial Production Report. That's compiled by the Fed itself and is due out on Friday.
And that tells us about manufacturing.
Exactly. It measures factory output, capacity utilization. It's a decent proxy for the health of the goods-producing side of the economy. So that report will get a lot of scrutiny.
And I guess those regional Fed surveys, the anecdotal stuff, become much more significant too.
Absolutely critical now. We have to really dissect things like the Empire State Manufacturing Index on Wednesday, the Philly Fed Index on Thursday, and investors won't just glance at the headline number. They'll be digging deep into the subcomponents. New orders, inventories, the prices paid, and prices received components for inflation clues, and crucially, the employment indices within those reports. They offer the most timely, granular hints about business confidence and activity that we can actually get our hands on right now.
And this whole data blackout must put immense pressure on the Federal Reserve. They keep saying they're data dependent. What happens when the data disappears?
It puts them in a terrible position. A data-dependent Fed without its primary data on inflation and consumer spending is severely hampered. It significantly increases the risk of a policy misstep. Well, think about it. If they're acting on incomplete or maybe lagging secondary information, they could easily misjudge the situation. Maybe they see weakness in manufacturing surveys and cut rates prematurely, only for the delayed CPI, when it eventually comes out, to show core inflation is still stubbornly high. Or maybe they hold off on easing because the limited data looks okay, while the missing retail sales data would have shown a sharp consumer slowdown. The risk of getting policy wrong goes way up.
Which makes any communication from the Fed this week incredibly important. The big event is obviously Fed Chair Powell's speech on Tuesday.
That speech is going to be watched like a hawk, probably more intensely than usual. Because with no hard economic data to react to, the market is going to parse every single word, every nuance in his tone. Did he sound slightly more concerned about growth? Did he emphasize inflation risks? Using words like transient versus persistent could move markets significantly. It's basically the only major input we'll get from the key monetary authority this week.
And other Fed speakers too, presumably.
Oh, yeah. Any comments from other Fed officials throughout the week will also be intensely scrutinized for any clues about their thinking in this data fog.
Okay, so if the macro data is missing or unreliable and the Fed is kind of feeling its way in the dark, that must mean corporate results, the Q3 earnings season that's kicking off, become the most important real-time check on the economy's health.
Absolutely. Earnings are more vital this quarter than perhaps any time in recent memory. They offer actual, current, verifiable insights into how businesses are really doing, how consumers are actually spending. And the season starts with a bang, a huge concentration of reports from the big Wall Street banks.
Who do we have reporting?
The Titans. JP Morgan Chase, Goldman Sachs, Citigroup, Wells Fargo, Morgan Stanley, and the asset management giant BlackRock. They all report early in the week.
And for these banks, given where we are with high interest rates and maybe slowing growth, what are investors going to be laser focused on?
Three main things, I'd say. First, simple loan growth. Is it holding up? Slowing down. That tells you about business confidence and demand for credit. Second, everyone will be watching net interest margins, or NIM.
Okay, can you break down NIM for us quickly? Why is it so crucial right now?
Sure. NIM is basically the difference between the interest income a bank generates from loans and the interest it pays out to its depositors. In a high-rate world, there's this lag effect. Initially, banks earn more on their loans as rates rise, so NIM widens, which is good for profits.
And eventually.
Eventually, the cost of keeping deposits goes up too. Banks have to pay savers more to prevent them from moving their money elsewhere for higher yields. If that cost of funds rises faster than the income they're making on new loans, then NIM starts to compress, squeezing profitability. So investors desperately want to see how well the banks, especially the big retail banks, are managing that squeeze.
Got it. That makes sense. And you said three things. What's the third, maybe the most worrying indicator?
That would be the provisions for credit losses. This is the money banks have to set aside to cover loans they anticipate might go bad in the future.
Yeah.
If you see a sharp, unexpected increase in these provisions.
It means the banks are seeing trouble ahead.
Exactly. It signals they're becoming more worried about defaults, whether it's consumer credit cards, auto loans, or maybe commercial real estate loans for businesses. A big jump in credit loss provisions would be a major red flag, a forward-looking signal of rising economic stress, pretty much regardless of what Powell says or the VIX does that day.
So the bank earnings are a critical window into potential stress. Beyond financials, who else is key this week? You mentioned TSM earlier.
Yes, Taiwan's semiconductors report on Thursday is massive, especially with all the trade tensions swirling. As the world's biggest chip foundry, their results, and even more importantly, their forward guidance, give you this unparalleled view into the health of the entire global tech supply chain.
What will we be looking for there?
We want to see if smartphone and PC demand is stabilizing. We want hard data on the pace of the AI data center build-out. And crucially, their commentary on global inventory levels. Are chip inventories still too high, or are they normalizing? What TSM says will set the tone for the whole tech sector for months.
And we also get reports from healthcare giants like J&J and Abbott and airlines like United giving us different pieces of the puzzle.
Exactly. Each report adds a bit more granularity. But the overall theme is clear. This earnings season, maybe more than any in a while, is the real gauge of economic resilience. It's where the rubber meets the road when the macro picture is so foggy.
So the key takeaway for the week ahead: forget the delayed government data for now. Focus on what companies themselves are saying and guiding towards.
That's absolutely right. Corporate commentary and guidance will likely matter far more than the backward-looking earnings numbers themselves, precisely because we lack reliable forward-looking macro data right now.
Okay, let's try to pull this all together. We had a powerful positive day for stocks on Monday, no doubt, but it was driven by very short-term geopolitical hope, the taco trade dynamic. And that hope was happening against this backdrop of deep structural fear that sent gold and silver to record highs and kept the VIX elevated. We're really at a crossroads.
We absolutely are. The market is fundamentally torn. It's making simultaneous bets on short-term political relief and medium-term structural risks like policy error or geopolitical breakdown. The fact that gold hit a record high on the same day the S&P surged over 1.5% just screams that institutional money is deeply unconvinced by the surface optimism.
Which logically means investors need to brace for more bumps, right?
Right.
More volatility seems almost guaranteed.
For significant volatility feels like the base case, yes. Because, as we said, the rally's foundation is speculative sentiment, not solid fundamentals. That optimism could evaporate incredibly quickly. All it takes is an abrupt return to hostile trade rhetoric or a really disappointing earnings report from a bellwether like TSM, or maybe a big bank flags a surge in credit provisions.
Or even unexpectedly hawkish comments from Powell trying to manage expectations in this data vacuum.
Exactly. Any one of those could be the spark that triggers a sharp, potentially violent reversal, which would instantly validate why the VIX is still high and why gold has been on this multi-week tear.
So that leads us to our final provocative thought for you, the listener, to chew on. Given how incredibly sensitive the market has shown itself to be to political headlines and this critical lack of reliable economic data because of the shutdown, is it possible that the real driver of the market right now isn't traditional corporate fundamentals or economic trends, but actually policy uncertainty, both the geopolitical kind and the domestic shutdown kind?
It's a compelling question. Are traditional investing metric almost temporarily irrelevant in this environment?
And if that's the case, what happens when that missing data, the CPI, the PPI, the retail sales, finally does get released?
That release, whenever it comes, will be a moment of truth, a real reckoning. It will either violently confirm the underlying fears that have been driving gold higher, or it might retroactively validate the optimism that fueled Monday's stock rally. Until then, you almost have to assume both outcomes remain possible. It argues for staying highly selective and maybe deeply hedged.